Welcome to Market Catalyst. I'm Allie Canal. We're 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, Nvidia results on deck. We break down what you need to know. Plus, India tariffs rise to 50%. We'll bring you the latest on the trade war. And we discuss the future of the Fed as Trump looks to oust Fed Governor Lisa Cook. Let's get a check on the markets and taking a look at the major indexes. We aren't doing too much here. You're seeing the Dow up around 100 points, just shy of that, or 0.2%. United Healthcare and Salesforce leading those gains in the Dow. You're seeing the S&P trade essentially flat, and the Nasdaq Composite is down roughly 0.2% as we await those key Nvidia earnings due after the bell today. Obviously, a huge impact on the stock market overall, and especially that tech-heavy index. And if we shift gears to the Treasury market, what's going on there? You're not seeing too much. The 10-year up around 2 basis points, still firmly below 4.3%. But we are seeing the 30-year yield up above 4.9% with a rise of just around 4 basis points. And we continue to track the moves in Treasuries and the bond market at large as we weighed that independent Fed question with Lisa Cook, President Trump. That standoff is still playing out there. Well, 50% tariffs on India are now in effect. President Trump imposing an additional 25% tariff due to India's purchases of Russian oil. That adds to the 25% tariff already in place. Yahoo Finance senior markets reporter Inez Ray joins me now with more on what this means. So Inez, India has benefited for years when it comes to cheap Russian oil. So given that the U.S. has now doubled those tariffs on India, what are the implications for the global energy market?
Yeah, Allie. So as you mentioned, India has been very much benefiting from purchasing Russian oil, China as well. So as the war in Ukraine has continued, China and India have been big buyers of Russian oil, which the EU has placed sanctions on as well, on oil caps for Russian oil. So you really have, or price caps, I should say, you have the situation where President Trump is utilizing energy, oil to negotiate, imposing these secondary tariffs because he's saying if you are purchasing Russian oil, then you are essentially helping fund the war in Ukraine. So this is a way for India to stop buying Russian oil, for Russia to have less funds to fund the war in Ukraine. And it is also a sort of negotiating tactic that analysts see for India to come to the negotiating table as well. So one analyst is saying that while India would come to the negotiating table with these 25% additional tariffs that are placed, he's saying that in the near term, the crude market is sort of shrugging this off. We have seen oil going a bit higher in some of these sessions, and that is because some oil targets, energy targets, Russian energy targets have been hit by Ukraine. So that is why we have seen some of the volatility that we've seen with oil. But if you take a look at oil year to date, you are still seeing that oil is down 13% for WTI, Brent crude down more than 11%. And what would really send oil prices lower is, of course, if you also saw the war end as well. So this is right now the market is sort of shrugging off these tariffs and doesn't expect the war to end anytime soon.
Yeah, and as we're looking at Brent crude trading at just around $66 a barrel, but Goldman Sachs out with a new note this morning saying that it expects the price of Brent to decline to about $50 a barrel. That's by late 2026. So what's behind the call there?
Yeah, so what they're saying is that this is all being driven by oil surplus, that you are going to have much more oil in the market than needed, that global inventories are going to rise to, they're expecting 800 million barrels by the end of 2026. There is an upside risk to these prices, and that is if China starts to accelerate more of their oil stockpiling, then you could see Brent actually a little bit higher than that at $62 per barrel for the average for 2026. But if you take a look across the board at where Wall Street is expecting oil to land next year, you are seeing JP Morgan that's expecting Brent to average $58 per barrel in 2026. Then you have the EIA that is expecting $51 per barrel in 2026. OPEC Plus has been increasing its production. We're seeing this oil surplus, and the expectation is a downward trend for oil from here, from the fourth quarter of this year and into 2026. They're expecting to see lower oil prices.
Ines Frey, thanks so much.
Thank you.
Well, President Trump made good on his threat to double tariffs on nearly all goods arriving from India to 50%. The new rate seeks to punish India for its purchases of Russian oil. Tariffs against India, the world's fifth largest economy, are now among the highest the U.S. has enacted in President Trump's ongoing trade war. Here to discuss the ramifications of this latest round, I want to bring in Greg Valari, EGF Investments Chief U.S. Policy Strategist. So, Greg, your reaction to Trump doubling those tariffs on India, are you surprised the two countries couldn't avoid this?
Yeah, a little bit. I mean, they both have had decent meetings in the last year. They both have talked a good game, but this is pretty steep. Looking on the bright side, Allie, I think that one of the positive stories over the last week or two is a real warming of relations between Canada and Germany. I think the leaders of both countries want to get more done. I think they're going to be very strong allies going forward.
And what about with the EU fast-tracking a deal with Washington? Does that offset maybe some of those more negative headlines with other countries? How are you looking at the impact here across the global landscape?
Well, we'll see how much money they raise. I mean, that changes almost by the day. I do think it'll raise some money. I do think that Trump will make this look like a big victory. But, I've been saying for the whole year, it takes months and months and months to get these trade deals done. They're maddening. They're painstaking. So I think it's premature to declare victory. It's going to take a while longer.
And I'm looking at the major indexes in the stock market, and they're not reacting too much off of this India news. Why, Greg? Are they underpricing some of that risk?
Yeah, it's not a positive story, obviously, but you've got to say, the big story right now is monetary policy continuing to be exceptionally accommodative. I think that's going to continue.
And you bring up monetary policy, and global markets are also watching the Fed amid the Trump-Lisa Cook standoff. The Fed saying that it will abide by the courts, but took no stance on the legality. Do you see that as a concession to Trump in any way?
Not necessarily. This is going to be one hell of a fight. I think that Lisa Cook is going to go after this. She's not going to relent. I'm hearing that there are other people in other agencies who are being investigated. It's outrageous. So if you had a parking ticket in 1982, are you going to get an investigation if you're a member of the Federal Reserve or some other board? This is really, really, really politicizing issues like monetary policy, and I think that's going to continue.
Yeah, and you have called this the start of an all-out war between the Fed and its critics. And now Bloomberg is reporting that the administration is reviewing ways to exert more influence over the 12 regional banks that's been traditionally insulated from politics. So how extraordinary would that be? And what could it mean for the Fed's ability to set policy independently?
Well, it's going to increase the fact that you're going to politicize monetary policy. You've already seen it from people you would expect, like Elizabeth Warren. But I think the Fed is now very, very politicized. And, here's the irony. But what if we get a strong employment report? Trump is saying we might get one soon. Well, what does he do? Does he cheer? If you get a strong unemployment report coming up, I think it just makes interest rates go higher. So be careful what you wish for.
So at what point do we start to see markets react, particularly in the bond market? It's been a little sleepy right now, especially if investors start to believe that the Fed is truly losing some of that independence.
It's a good question, and I do think that's a possibility. I think for Trump, who, let's be honest here, Trump made a specialty out of mortgage fraud in his days in New York. I mean, he was quite adroit at mortgage fraud, and now we're in another area of mortgage fraud. If he keeps going after people in his own administration, like he is with Cook, I got a feeling that this is going to be a very nasty run here where he does not get what he necessarily wants.
So let's say he does get what he wants and the Fed cuts rates in September. Does the fight end there, or do you think this exertion of control on the part of Trump just only continues?
Well, it might let some of the steam out, but I was talking to people before Jackson Hole. There are people around Trump who want 50 basis points. They were saying that 25 is not sufficient, and I think that Trump will probably make that argument as we get into the fall.
Yes, and currently the markets are just pricing in that 25 basis point
Just, yeah,
cut.
just 20. That's right.
Yep. Well, Greg Valeri, thank you so much. Really appreciate your insights.
Okay, you bet.
On Tuesday, market domination host Josh Lipton spoke with former Federal Reserve Bank of Cleveland President Loretta Mester about what the pressure from the White House means for the future of the Federal Reserve's independence. Here's what she had to say.
I think the bigger question is really, what does this mean in terms of how the Fed is perceived? And the danger here is, even if the Fed continues to go about its work as it will, in terms of making sure that it's doing what it can to set policy to achieve full employment, maximum employment, and price stability, there's now a perception that they may be influenced by other considerations. And that's why this is a difficult situation for the Federal Reserve, right? Some of their credibility is going to be affected just by the perception that they may not only be setting policy in the appropriate way to achieve those goals. And that means it could result in higher long-term interest rates, something we know the president has stated he does not want. But, if the markets and other investors begin to question whether the Fed is actually setting policy independently, that could very well happen. The value of the dollar might continue to decline, right? So it really undermines the economy, and it undermines the economy and hurts the American people. If there's questions about inflation, maybe the president wants low interest rates in order to finance the public debt, which he has stated that was one of his goals. That's inflationary. That hurts the American households and businesses. So again, this is could be very damaging to the American economy and to households and businesses. And that's why this is it's a bigger thing than any one individual. This is a potential threat to how monetary policy and the Federal Reserve as an institution sets policy appropriately. And that's why it's dangerous and could potentially be very bad for the American public.
Can you think, Loretta, of any other examples that mirror what we're seeing right now between Trump and Cook, or are we in uncharted territory here?
Well, we certainly have seen presidents try to influence monetary policy. There are a lot of examples of that from both Republicans and Democrats. Typically, what they want is to see low interest rates, and the timing is usually in an election year so that the economy looks like it's very strong going into the election. And certainly in the 50s, that was when we sort of got to a point where there was this agreement between the U.S. Treasury and the Fed that the Fed would run monetary policy and the U.S. Treasury would not force them to peg interest rates at a low rate. But since that time, this has been the most egregious and aggressive attempt certainly that I've seen, and historically, I think since the Treasury report in the 50s, to try to influence U.S. monetary policy. You've seen it in other countries, of course, and it usually turns out very poorly. And that's what I think the concern is here. Now, there's a lot we don't know. And I think, sending it to the courts, they're going to be the ones who have to decide whether, the president has the power to do this or not. We don't know any of the facts, right? We know there's allegations. But as far as I can see, there's nothing that really gives us sort of an evaluation. But by putting out, I'm firing Governor Cook, the president has sort of circumvented the due process way of going about when these things have come up in the past. And of course, the Fed has had cases where they have had, someone alleged that there were improprieties in investments of some of the members of the FOMC. And of course, those were looked into. So there is a process that should be followed. And that process was sort of set aside, and we went to this very aggressive potential firing by the US president of a governor. And that, I think, is not a good procedure for this to happen, right? You know, when questions come up, it should be evaluated and it should be looked at and taken seriously. And Governor Cook, in her initial communication, said that she does take this very seriously. So I don't think there's any question of that. But this ratchets it up in a way that I have not seen and we haven't really experienced before, at least within the Federal Reserve context. I mean, we've seen it, I think, with this president in other parts of the government, but not at the Federal Reserve.
And Bloomberg, Loretta, does have some headlines here. They have a statement from the Fed saying the Federal Reserve will abide by any court decision, that governors may only be removed for cause, which is what you were just talking about there, Loretta. And that is listen, as we try to figure out whether Trump does have the legal authority to do this, that seems to be the debate, Loretta. We have to define what cause means here.
Right. And that's what the courts are going, I mean, that would be what the courts would do, right? Not everything is specified, right? So the law says for cause. Now it's up to the court to interpret what that for cause means. And we saw an earlier Supreme Court judgment about independent agencies and what can and can't. And in there, they talked a little bit about the Fed and saying the Fed is special in some way. This will now be the courts will have an opportunity to define or interpret what cause means. And of course, I'm not surprised that the Fed will abide with what the court says. It is an institution that really does value, following the law. And so I'm not surprised at all that the Fed will follow the law.
Loretta, great to see you as always. Thanks for joining us.
All right, welcome back to Yahoo Finance. Abbott Labs announcing a new partnership with the Big Ten Conference to address the worst U.S. blood shortages in decades by promoting donations on college campuses. Joining me now on this is Robert Ford, Abbott Chairman and CEO. Robert, nice to see you here this morning. I believe you're coming to us from the New York Stock Exchange, so you ring that bell. Must be an exciting moment for you all. I think many would be surprised to hear we have blood shortages in this country. Take us through the extent of the issue.
Well, it's not good. Most hospitals and blood donation centers have about 1 day's worth of blood supply, in the hospitals or on these centers. So if you think about every 2 seconds an American needs blood, whether it's because of a traumatic accident or undergoing therapy, et cetera. So that's not good. So we want to get ahead of it, and we partnered with the Big Ten. This is the second year we've done this. We partnered with the Big Ten to create a friendly competition amongst the Big Ten schools and see who can donate most blood, and we'll announce the winner on the championship game on December 5th. Every donation can save up to 3 lives. So I think this is an important cause for us, and I think it's important for the country also.
In the analysis that you and your teams do, I imagine on an important issue like this, why is it happening?
I think what we've seen, if you think about what happened during COVID, a lot of things that were interrupted in COVID have snapped back. We're back on cruise ships. We're back traveling. We're doing all this stuff. One thing that we noticed that didn't come back was people donating blood. And I think what ended up happening there is we saw a decline in the, let's say, the boomer generation, the Gen X generation that are becoming a little bit older or, taking medications that will prohibit them from donating blood, and we didn't see the newer generation kind of step up and fill that void. So this is why what we're doing is important, because not only does it help create solve a shortage, but then our goal is to create a long time, lifelong donors to ensure that we've got a resilient blood supply in this country.
This definitely seems like an initiative the whole pharma industry could and should rally around. Have you talked to your peers about how they can perhaps join forces with you on something like this? I mean, when you tell me that data you cite at the top, blood levels at hospitals, that's a serious issue.
That's a serious issue. And listen, we're one of the leaders, and as part of our portfolio, we test the blood supply of the blood centers of the Red Cross and other blood centers. So we test those bloods to make sure the blood supply is safe. So we get to see what's going on. So really, our job as the leader is to really work with all the different stakeholders, whether it's partnering with the Big Ten to create a new generation, but also working with the blood supply network across this country to ensure that we're doing everything we can to encourage donations. If you think about it, it's really 30, 40 minutes of your time, and you get to save 3 lives. I cannot think of the best ROI. If I'm a CEO, I think about ROI. I cannot think of a better ROI for those 30, 40 minutes.
Well, I'm glad you brought up ROI, because I want to change gears a little bit, Robert, because the last time I follow your company closely, but the last time earlier this year, you made a really important announcement, investing $500 million in to boost your U.S. manufacturing in 2 plants, Illinois and Texas. What's the update on those plants? Where's the progress?
So those manufacturing sites are for our diagnostic products, and those will be up and running. So one in Illinois and another one in Texas. Those will be up and running by the end of the year. We also announced a couple weeks ago a new manufacturing cardiovascular investment. We have a very strong cardiovascular portfolio, and we're making a new investment in a new manufacturing site in Georgia. So reallocating our capital to ensure that we can ensure that we've got resilient supply and can capitalize on the demand that we're creating with this incredible pipeline of products that we have.
How do the economics change for your business making more products in the U.S.?
Well, we've always had a philosophy to align our demand with our production. So we have about 90 manufacturing sites. About 40 of them are here in the United States. So a very large percentage of our U.S. revenue is supported by U.S. manufacturing, and our international revenue is supported by international manufacturing sites. And one of the things that we've done over decades is we do that because it helps mitigate kind of the impacts of foreign exchange, aligning your cost structure with your revenue structure. So that's been a philosophy of ours. We're seeing a lot of demand here in the United States for some of our products. So that's why we're building these manufacturing sites over here. And also we made an announcement a couple years ago for a new nutritional manufacturing site that we'll be working on also in the United States. So it's really thinking about a much larger context. It's not necessarily driven by tariffs, but it's about really aligning our cost structure with our revenue structure. And we're seeing demand grow outside the international markets. We're seeing growth here in the United States, and that's how we build our supply chains.
So Robert, I have to tell you this, you're sitting on a lot of cash. That's a good thing to be in. You have those manufacturing plants overseas. The dynamics in the economy have changed in large part because of tariffs relative to April. Could you see yourself making another $500 million investment in this country? Does the business support doing that as you look out over the next decade?
Well, so we've got a very disciplined capital allocation plan. We obviously allocate to the programs, our internal CapEx programs that generate great returns. So building new manufacturing sites, whether it's international or here in the United States, to support the growth, this provides a great ROI. We also allocate some of that capital, some of that balance sheet that you referred to, back to our shareholders. So we pay a growing dividend. We've been growing our dividend for over 53 years. So we have this ability to really invest in the future, to drive the future through our pipelines and manufacturing, while at the same time having our shareholders be rewarded with that in the short term through our dividends.
What's the impact, broadly speaking, for the pharma industry as these tariffs come into play? What's the trickle-down effect as we look out?
Well, we're not really, I'd say, I think pharma is I won't comment too much on pharma because we're not a pharmaceutical here in the United States. So the majority of our business in the United States is nutrition, diagnostics, and medical devices. And like I said, most of our sales here in the United States, we have manufacturing sites that support those products in cardiovascular and diabetes and nutrition and diagnostics. So right now, our impact between the whole network is just under $200 million. But I think the key thing here is, one thing that we have learned is, once tariffs come in place, whether in the United States or in another country, they do not go away. So we need to think about how do we mitigate that, not just in the short term, but also long term. And that's really about making long-term investments in your manufacturing, your supply chains.
Robert, before I let you go, last time we heard from the company, you had another strong quarter in things like Pedialyte, some of those consumer products. It was the diagnostics portion of the business that perhaps had some on the street concerned and really focused in on the guidance. How is that business doing?
That business is doing very well. I think what we basically highlighted is that, in one of our markets, in the Chinese market, we've seen our laboratory business decline in revenues because of implementation of new pricing policies. That will flush out, at the end of this year, and we'll go into the next year with that already behind us. But the other parts of our core diagnostic business, like the United States, grew, high single digits. Latin America grew in the teens. Europe grew in the high single digits also. So the core of the diagnostic business was very strong and capitalizing on all the momentum we have in that business. It was really this one market that kind of created this challenge, but that'll be behind us next year, and then we'll have the rest of the business continue to drive what historically has been a mid to high single digit grower for us.
Well, good luck on this Big Ten partnership. Enjoy your day at the New York Stock Exchange. I know it's exciting to be down there. Robert Ford, Abbott Labs Chairman and CEO. We'll talk to you soon.
Thank you.
All right, coming up, Allie Canal brings you the top trending tickers on the Yahoo Finance platform next on Market Catalyst.
Welcome back to Yahoo Finance. I'm Brooke Tamama. We are live at the NASDAQ. Let's get a quick check on the latest market action. About 1 hour into today's trading session, we're seeing all three major indices flip to the upside here. The Dow leading the momentum here, up about 0.2% as we make our way into today's trading session. We also do have the NASDAQ up about 0.1% after reversing previous losses that we saw earlier in today's trading session. And the S&P 500 also gaining a bit of momentum here as we make our way into today, up about 0.2%. I do want to take a look at what exactly is leading some of the momentum that we're seeing here. Go to the Dow first. We're seeing the most momentum there. That's led by Microsoft, Apple, Amazon. We're also seeing Home Depot as well as Salesforce up about 2% in the early innings here. But taking a look at the NASDAQ, because all eyes are on Nvidia today. Stuart Kaiser at Citi saying that this is one of the biggest macro risks on the calendar right now. There's lots of momentum heading into Nvidia's report today. Month to date, the stock is up about 1%, but year to date, it has had quite the run, up nearly 35%. And Nvidia has really led this AI arms race, this AI revolution. And so there's lots of momentum coming into this report. AMD down about 0.6%, moving in. Of course, there's been lots of discussion around that chipmaker as well. I do quickly want to hit on retail because we are seeing some of the biggest gains in today's trading session coming from companies like Kohl's. Right now, Kohl's shares are up more than 20%, and that's largely because they raised their full year profit forecast this morning alongside their earnings as the company really undergoes this turnaround plan. Right now, there is an interim CEO there, but there has been this momentum that the company is really doubling down on inventory management. They're also bringing back jewelry to the front of the store, and we know that Sephora has done really well for them. I also want to bring up American Eagle because right now American Eagle is getting a bit of a pop here in intraday trading, and that's because I'm seeing headlines cross the wire that they're doing a limited time collaboration with none other than Travis Kelce, who of course been in the headlines for his engagement to Taylor Swift. This will be a limited edition collaboration featuring lifestyle and sportswear called AEX True Colors by Travis Kelce. So investors certainly optimistic about that. Of course, American Eagle has been in the headlines over the past month because of that campaign to Sydney Sweetie. We did see a bit of a reversal from that pop that we got earlier this month. And lastly, but not least, Abercrombie & Fitch getting a bit of a pop this morning, up about 2.5% after their company reported earnings that topped Wall Street's expectations. But they did see a decline in their Abercrombie brand, but that was largely offset by Hollister. Taking a look back at all three major indices, once again, we are in the green to start today. Leading the momentum is the Dow, up about 0.2%. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves throughout today's trading session.
Now time for some of today's trending tickers. We're watching Canada Goose, the Royal Bank of Canada, and Williams-Sonoma. First up, Canada Goose. Shares surging after CNBC reported the company is said to have received take-private bids, valuing it at $1.35 billion. Its controlling shareholder, Bain Capital, is said to have received a few offers to take the maker of parkas private. Bain Capital is holding off on a decision until more offers roll in, the sources said, adding that once a buyer is selected, due diligence is expected to take less than 2 months before the deal is signed. Next, RBC, the Royal Bank of Canada, topped estimates on strong performance across its biggest businesses, and as the firm set aside less money than expected to cover possible loan losses. The credit loss provisions mark a rebound from notable misses on credit earlier this year, which sent shares higher today. The bank also posted record revenue in its capital markets division, up 25% from a year ago. Finally, Williams-Sonoma raising its full-year sales growth target as a strong second quarter showing across all brands eased concerns of increased tariffs. The company, which also owns Pottery Barn and West Elm, kept its profit guidance steady. However, its CEO did say that higher net revenues will be pressured by incremental tariff costs. On the earnings call, the CEO added that Williams-Sonoma is getting cost concessions from vendors. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. All your market action straight ahead. Stay tuned. You're watching Market Catalysts. Nvidia earnings are out today after the close, and Wall Street is expecting it to spark a busy day of trading. Market Domination host Josh Lipton spoke to Bob Lang, technical analyst at Explosive Options, about potential option plays around the AI powerhouse.
I want to play it a little bit more cautiously here right now, because after that huge surge on Friday, fueled by Chair Powell's somewhat dovish comments at Jackson Hole, volatility really took a tumble, Josh, on Friday. It fell below 15%. We haven't seen those kind of low numbers for several months now. And generally speaking, when we're around that 14-15% range, it means that the markets are somewhat complacent right here. And you got to be careful here. We do have the end of the month coming up here. There's going to be some window dressing coming up. We do have their Nvidia earnings, as you mentioned, tomorrow night after the close. It's going to be a little bit of excitement as we move into the holiday weekend. Of course, volatility tends to be subdued going into the holiday season. I think where we have to be careful, Josh, is right after the holiday, starting Tuesday, Wednesday of next week is when things are going to get a little bit more bumpy.
All right, let's talk specifics here, Bob. As you mentioned, Nvidia earnings on deck tomorrow after the close. How do I want to play that through options? What's the trade?
Well, I think it is a really good way to trade Nvidia through options. You know, the stock is up 33.5% since the last earnings report hit, and a lot of anticipation and excitement, enthusiasm was coming into that print back in May, and really it was just a thud of a reaction. But interestingly enough, you know, the way big institutions accumulate stock, Josh, is they don't necessarily jump in right after the first print. They sit back, wait a little bit for the price to settle down. And that's kind of what they did in May and early June. And then we saw big institutions starting to come in after the stock real heavily back in June, July, and early August. So where I'd like to see the stock go is to about, I'm thinking that the stock can make a run towards 200 over the next couple of months. And with the stock sitting about $181, Josh, I'd like to see maybe buying like the October call, the 180 call, a little bit expensive right now. It's about $11. I would like to maybe sell the 195 call against that for the same, basically the same amount of contracts, get about $3 of credit of that, and I can cut my risk by about 27% by buying that that calendar diagonal spread.
Outside of Nvidia, Bob, I know you're also eyeing Alphabet. Walk us through what you're seeing there.
Yeah, so you know, Alphabet just hit a new all-time high just a couple of days ago, which is really impressive. It's actually been the best performer out of all the Mag 7 stocks for the past month and a half. It really had been a laggard for most of the summer, and then the earnings came out in July, and they were real strong. And a lot of people really hesitated to jump into Google, Alphabet, but not the big institutions. We saw a lot of big institutional money coming in to that stock over the last 3.5, 4 weeks, and we did see some large option trades as well too, as it was running up to the all-time high. So I would like to take a look at Alphabet here with a trade like maybe the October 205 call, which is selling at about $10.50. I would do the same thing, Josh, as I did with the Nvidia, selling the September 220 calls. Now that's about 15-17% away from the current strike. I think that that's pretty safe bet there, because September there is no real earnings risk or any other risk as well too. We can get a nice little premium by selling that particular call, Josh, and maybe saving at about 20% and having a nice play going into October. The stock usually does well leading into earnings.
Finally, Bob, before we let you go, got Nvidia reporting. You also do have Alibaba reporting. They're scheduled to report August 29th. Ahead of that print, Bob, what's the options play?
Boy, that one really has me curious, Josh. Friday morning, they will print their earnings 2 days after Nvidia. The stock has been rather strong of late, but the stock really just doesn't move unless the Hong Kong market moves. And I've seen a lot of good, strong correlations there. When Hong Kong market is up one real strong, like it was last week, you saw Alibaba move really nicely to the upside. But I would be careful in this one. The stock had good earnings last time around. It ran up and it pulled right back again. I think people were a little bit more hesitant. I think this time around, though, it's got some staying power here. And I think if the stock moves up nicely up to above 130, it's got some ground to go. So I would be looking at Josh saying maybe making a 125 October call play right now. It's selling for about, I think about $10.5, $11 right now. And if it gets above that 130 level, I think that's got some room up to about 145, maybe 155 by the end of October. So we can manage that trade if we get to past that 130 level. But I do like that stock going forward.
Bob, appreciate your time in those trades as always. Thank you.
Great to be with you, Josh.
It's full steam ahead for the U.S. ETF market, with flows on pace to surpass $1 trillion again this year. But could economic factors such as a potential September rate cut alter the ETF picture for investors? Let's bring in John Mayer, J.P. Morgan Asset Management Chief ETF Strategist, for this week's ETF report brought to you by Invesco QQQ. So, John, $1 trillion in inflows, that's what it's expected, and we're seeing a lot of momentum in active ETFs. Can you first give us a breakdown on what's different from active versus passive and why we're seeing such strong gains in active?
Sure, and that's a good question. The ETF marketplace is made up of both active and passive ETFs. Approximately 10% of the assets are active and 90% are passive. Passive ETFs follow an index, rules-based. So you know exactly what's inside the index based on the rules made up from the index provider. And an active management is you actually have a manager that manages the underlying portfolio. That's the big difference. One is rules-based, and one, you have a human picking the individual securities that's inside of the portfolio.
And why is that the choice today? Is it because of all the volatility we've been seeing with tariffs and all their economic uncertainties?
Well, I think the increase in actively managed ETFs started in 2019 when there was a rule change that made it simpler to bring an active ETF to the marketplace. So that was one thing that happened in 2019. You saw a lot of active mutual fund issuers come to the market with ETFs, whether it be new ETFs based on different strategies or clones or conversions. So that's another reason that's you're seeing more active ETFs in the marketplace. Also, now you're coming up with a 3-year track record. And that's important for investors because they want to see how that active manager did. So that's another reason you're seeing investors utilize actively managed ETFs.
There should be a lot of activity over the coming weeks because markets are pricing in that September rate cut from the Federal Reserve. So how does that steeper yield curve change the calculus for ETF investors or the playbook that they should be following?
Right. So if you go on the expectation that rates will decline, short-term rate or policy rates will decline 100 to 125 basis points over the next 12 months, your cash is going to be earning a lot less. Now, we know there's about $6.5–7 trillion in money market funds. Now, if you're getting lower rates, what do investors want to do? They want to get higher rates, right? So they're going to move a step out of cash. Stepping out of cash into actively managed funds like some of ours, like intermediate core bond, J-bond, JBND. That provides a little bit higher of a yield, approximately 5%, and it's an investment grade portfolio. So you are seeing investors, we expect investors to move out of cash into slightly longer duration instruments.
And given the moment where we're at with markets when it comes to AI, the Fed, emerging markets, where are you seeing ETF investors lean in a little bit more right now?
Well, with active management, you can pick individual securities. We talked about earlier index versus active versus passive. With an active manager selects those securities, selects those individual names. So if a certain stock has moved up too much and that manager feels like they should pull back, they can do that. They cannot do that in a passively managed portfolio. That being said, I think if you look at where assets are flowing towards, particularly on the equity side, you're seeing movement towards the more traditional asset classes like large blend, value, as well as intermediate bond and international. And that's another area of great interest.
And fun fact here that we now have more ETFs than individual stocks, more than 4,300 funds. Do you worry about choice overload for investors? And how do you parse through all of these options and pick the ETF that's going to work best for you?
Right. Yes, there's certainly, as you mentioned, over 4,000 ETFs out there. So there's lots of choices. Not every ETF is on every platform. So that's important. Financial advisors can certainly guide you and investors towards different strategies that work for an investor's goals and timeline.
Mm-hmm. And with all the uncertainty around Fed, tariffs, the macro unknowns, are there any more defensive ETFs that you would point investors to hedge against some of that volatility?
Well, first of all, there's an ETF for almost anything you want to do. One of the key aspects of ETFs, they're accessible. They access different parts of the market. So again, it really depends on your time horizon, your goals. So if you are more conservative, you may want to look at something like a J-bond for yield, or JPST for a step out of money markets. If you are still looking for income but reduced volatility, we have a fund. The largest actively managed fund out there is JEPI, J-E-P-I. It has two components. It has the underlying portfolio, which is a lower volatility portfolio, and then it has an option overlay. That option overlay, writing index options, 2% out of the money, provides investors income and also reduces the overall volatility of the portfolio.
Mm-hmm. So. All right, well, John Mayer, not to be confused with the singer, but the ETF master here for today. Thank you so much for joining us.
Thank you.
Coming up, a full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Welcome to Market Catalyst. I'm Allie Canal. We're 90 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, Nvidia results on deck. We break down what you need to know. Plus, as the U.S. raises India tariffs to 50%, we'll look at how retailers are faring. And what's the biggest risk for investors? One investor says stagflation. We'll discuss that and more throughout the hour. Well, 90 minutes into the start of U.S. trading, let's get a check on the major markets. I'm taking a look at the major averages, all firmly in the green at this point. You're seeing gains being led by the Dow, up roughly 100 points. The S&P and the NASDAQ right around the same level there, up around 0.1%. Of course, markets and investors are waiting for those key Nvidia results due after the bell later this evening. And Nvidia, the most valuable company on the S&P 500, reports second quarter earnings after the bell tonight. Investors will closely be parsing CEO Jensen Huang's commentary on the call, particularly when it comes to the company's relationship to China. Here with more is Hope King, Macro Talk News founder and Yahoo Finance contributor. So Hope, the biggest question into this report is China. Will Nvidia offer guidance, if at all, when it comes to China sales? So what are you looking out for?
Yeah, and I have to say, every quarter, you know this, every day, it gets harder and harder to say something new and original about this company and the stock. And that's because it's transcended, right? Beyond just a company that we talk about and just this big driver of the markets. It's become an abstraction. It's become almost a Rorschach test for people who are, when you look at it, you can see all kinds of things. You can see market domination. You can see tech sector concentration, AI fears. But this China question is this big one for this afternoon. And I'm going to be, along with, I'm sure, everybody else, reading very carefully between the lines of what Jensen Huang says on the call. And I know you guys have him on your show in the afternoon as well. And why I'm saying that this is going to be a really important skill when it comes to understanding NVIDIA is because he and the company are towing an incredibly thin line when it comes to talking about their relationship with the Chinese market and with the US government now looking to get a cut of revenue going into China, the relationship between these two countries, you have Nvidia squarely in the middle. They're basically a pawn. I've written about this in the past. And so how they navigate that tricky situation, this tricky situation that we're in, that many companies find themselves in, will be the key to watch, because we need to really read between the lines of what he's saying. Will China be important to the growth of the company going forward? Does the US need to understand what China is doing to understand their own national security risks? All of that is at stake.
And to that point, CEO Jensen Huang said on the last earnings call that the platform that wins China is positioned to lead globally, and that China's AI moves are on with or without U.S. chips. So just illustrate some of the China push here. So when it comes to the U.S.-China trade tensions, how does CEO Jensen Huang really toe that line?
I mean, he's been doing it pretty well. You've seen him go abroad to China to meet with press there, to sign. I think there's a very viral clip that people have been using of him signing a leather jacket, someone's leather jacket, right, with his name and this glossy ink. And he's become a diplomat. Yeah, you're going to show it right now. I mean, you know, what's really fascinating too for me and Nvidia and with CEO Jensen Huang at this point is that they are also tying the future of US AI dominance to Nvidia's success, right? In that same earnings call last quarter, he talked about the fact that the US has to be smart about their export controls, and that policies shouldn't limit the growth of his company, of US AI innovation. And so I find that role that he is playing to be very, very interesting and unique to him. But it just, again, signifies this bigger macro picture that I've been really trying to focus on, you know, to figure out like why is this company on the top minds of everyone? And it's because it touches so much. And it's because, like I said at the beginning, it has transcended beyond just a stock. It's transcended beyond just a company. It is a symbol now of geopolitics, of our AI hopes and fears, of what the markets are doing. And so, you know, again, it's hard to find something new to say every day about this company. And that just, again, is symbolic of how important this company is to the whole world at this point.
Yeah, well, we'll certainly have a lot new things to say tomorrow after these results. Hope, thank you so much.
Thanks.
And a reminder, Yahoo Finance will be speaking with Nvidia CEO Jensen Huang live at 6:30 p.m. Eastern Time. You won't want to miss it. Well, Nvidia's upcoming earnings report Wednesday evening will offer a key test of just how durable AI demand really is. One derivative play in the AI trade is Bitfarms. The cryptocurrency miner has recently expanded to building and operating data centers that support AI infrastructure. Ben Gagnon, Bitfarms CEO, joins me now. So Ben, Nvidia's earnings once again expected to highlight that strength of global AI demand. Now, your company transitioned from crypto mining to AI computing. What really drove that decision, and how do you see this as a market opportunity compared to crypto?
Yeah, it's a great question. There's a lot of companies like Bitfarms making this transition right now. And the reality is that, you know, we've built up these really attractive energy portfolios. And while Nvidia is out there developing these fantastic chips, it still takes a lot of power to run them. Some of these, you know, expectations are that with the amount of chips and the amount of racks that Nvidia is shipping out just in Q2, it's going to consume over a gigawatt of power. And as those deliveries really, really scale up, you know, the demand there for all this money that's been contributed into GPUs really means that you need to make a considerable amount of investment into the data center infrastructure to power them. So it's really, really big market opportunity for everyone who has a bunch of power in order to tap into this hot market on HPC and AI right now.
And we are seeing hyperscalers like Meta, for example, announce big AI data center projects in the US. You're expanding in Pennsylvania up to 300 megawatts of capacity. Is that build out designed with those kind of customers in mind?
Yeah, absolutely. You know, the reality is that the GB200s and the new chips that NVIDIA is making for AI today really cannot be run in the data centers that were built yesterday. These are completely new kinds of compute technologies with very, very intense heating and cooling requirements. And so it requires something called liquid cooling. And really, most data centers don't have that. When you're looking at kind of how the growth of the industry is going to be happening over the next couple of quarters and years, just the amount of racks that Blackwell is supposed to be shipping by Q4 is supposed to double from Q2 to Q4. And that's going to be roughly something like, a few gigawatts a year, and forecasting for it in 2026, we're looking at 6 to 8 gigawatts just on the Nvidia Blackwells, not including the traditional HPC, the data storage, and all the other products by AMD and others. So big energy markets like Pennsylvania, which powered the Industrial Revolution, are really now coming into the forefront as we're looking at this AI Industrial Revolution. And it's really coming back into full swing here. That's why I think you've seen a lot of companies making investments and committing to Pennsylvania. And it's something that Bitfarms has done in a big way. We've got about 1 gigawatt of power there in the state to build out and develop over the coming years. And we're hoping to capture a really significant market share of this HPC and AI infrastructure.
Now, your U.S. expansion does come as companies face more uncertainty overseas, whether it be China export controls, new tariffs, political pressure out of Washington. How much is that climate shaping your strategy at home? What advantage does that give you?
Well, we've actually always been a very international company. And over the last year, our focus has been entirely on the United States. There's a lot of reason for that. There's very, very robust energy infrastructure and energy resources in the United States. But more importantly, I think when you're looking to make the investments in this kind of infrastructure, you really want to position it in the right locations in the right market. And, while I know there's a lot of talk around China right now, the reality is that, yeah, it's a big population, it's a really big market, but the latency is really, really important when it comes to these data centers. And because of the great firewall that's in place with China, data centers in China really only service Chinese customers. When we're investing in data centers, we want to really focus on the United States customers and the international customers. And so when you look around at our portfolio, not only are we in major data center clusters outside Virginia and Washington, but we're also really strategically located next to the deep sea underoptic fiber cables that really connect the United States with Asia, Europe, and the rest of the world. So this is really, really interesting and strategic locations to be building out this HPC infrastructure.
So do you think that domestic ramp up, what we're seeing in the United States, would have happened regardless from the political pressure from Trump? And do we have enough supply to meet all that demand?
I think this was going to happen regardless of what happened politically. AI is really, really transformative when it comes to how people interact with computers. I think, for a long period of time, humans needed to learn how computers think and program and communicate with computers the way that computers think. Now computers are learning how humans think. And because computers can now think like humans and can interact with humans, it really reduces the interface problem between humans and computers. And we've barely begun to scratch the surface of what's possible now with artificial intelligence. So I think the demand is there. It's certainly there on the compute side. I think the capital is there for all these projects. The real bottleneck on this growth is going to be on the power infrastructure. And so for the companies who are building out this new HPC and AI infrastructure and have access to the power already, I think they're going to be in a really, really good spot in order to take advantage of this huge influx of capital.
All right, to your point, lots of folks have told us early innings of AI. Ben, thank you so much. Appreciate it.
Thank you.
All your markets action ahead. Stay tuned. You're watching Market Catalysts. Luxury watch brand Breitling announcing a historic partnership with the NFL, becoming the first ever official timepiece partner for the league. This comes as the company says it is doubling down on the U.S. market amid the global trade war, with 39% tariffs on Switzerland currently in effect. Joining me now is George Kern, Breitling's CEO. Yahoo Finance reporter Pras Subramanian also joins us for the conversation. Thank you both so much for being here. So George, you're doubling down on the U.S. market. What does that look like in practice, and why is now the right time? Is it because of what's going on globally with tariffs?
So first of all, the US is our biggest market, roughly representing 23% of our turnover. It's a growing market, a market with huge potential. So, and we're very happy in that context, obviously, to be partnering with the NFL. But other projects will come on board. We believe in the market. And yes, we have that issue with the tariffs, which has been a little bit of a shock for the Swiss population, but I hope it will be solved in the next couple of weeks, I would say.
So how are you safeguarding your business in the meantime to handle that shock? Does it have to do with your supply chain? Are there levers that you can pull to offset some of that risk?
Yeah, so we did ship, obviously, some watches beforehand. So we have some stock, roughly 3 months of stock available here in the US. And we'll see how the negotiations will develop in order then to decide if we have to increase prices or not. I hope not.
So far, no price increase.
For the moment, no price increase, but it could change depending on the negotiations. Switzerland is a very friendly country to the US. We are the biggest per capita investor in the US. It's a small population, 8 million people. We employ 450,000 people in the US. We pay the highest wages from all foreign countries to the US colleagues working for Swiss companies. So I mentioned that even our constitution is inspired by the American Constitution. We are the sister country of the US. And if somebody can get me a meeting in Mar-a-Lago, 10 minutes.
I was going to say, we need to bring this to President Trump. I like the pitch.
Give me 10 minutes. Let me talk to him, and this guy who will organize that meeting get a watch from me.
So just real quick before the NFL stuff, you're hopeful that there's a deal going to be in place soon. Is that what you're saying?
Yeah, of course. It has to. I mean, it doesn't make sense. We have the highest tariffs from all Western countries. 39%. I mean, UK has 10%. EU has 15%. We are not part of the EU, by the way. We are a neutral, independent, free country. And we need, obviously, trade with the US to remain independent, free, and neutral.
So Allie mentioned doubling down on the US consumer, and obviously tariffs are a big part of that, but also the NFL. This is a big deal. I was kind of surprised to see Breitling, a big Swiss brand, partnering with the NFL, arguably the biggest sports brand in the US. Why does that deal make sense for you? And obviously you're targeting the US consumer. Why does it make sense internationally too?
First of all, the NFL, and you know that better than I do, is so American. It represents so much the American values. It's about the game, it's about tactics, it's about strategy, it's about strength, it's about speed. All these factors correspond to Breitling. The values correspond to Breitling, the team spirit correspond to Breitling. And we are perceived somehow also as an American brand. And as you know, the NFL is growing, is expanding. Yes, there are over 100 million viewers in the US for the Super Bowl, but there will be 7 games outside of the US this year for the first time. Even one in Brazil, which is the mecca of soccer and not football. Many games in Europe. So I think there's a major plan to develop the NFL outside of the US.
You talk about the US market and the international presence. Talk about the watch market in general, the Swiss watch industry globally. What's sort of your take on where we are right now with a lot happening with the luxury consumer, tariffs, of course? How do you think what is the health of that industry right now?
Okay, you have to distinguish what is happening right now and how the market will develop. I'm not worried at all about the market. You cannot fight demography. There will be more and more people having access to this type of price points in China, in India, in Indonesia. All these countries are gigantic. We're talking about hundreds of millions of new customers coming into the market every year. So that's one point. So I'm not worried. And people like analog watches. They like to know what is really happening in a world of over digitalization. So we are humans at the end of the day. People like these type of all type of products. Then, of course, we have crisis. We had COVID. We had, a couple of years back, Lehman Brothers. But this happens. But you have to look at the long-term trend, and that trend will continue to be positive. And now we have to deal with the current, socioeconomic situations. Obviously, consumer sentiment impacted by the war in the Ukraine, Gaza, and all these aspects. Now we have the tariffs. We have to navigate through this. But again, I'm very hopeful that at least we're going to solve the tariffs very soon.
So how is the American luxury consumer different from maybe some of the foreign buyers that you see? Are you seeing any types of trading down?
No, I mean, in the old days, you had the East Coast and you had the West Coast. But today, the biggest sales we have in the US are in Texas, very much also in Florida. The market has been developing a lot. The sophistication of the market has been developing a lot. We have 45 boutiques here in the US. As I said, the wealth is there. I mean, that's at the end of the day, the wealth is there. You have a growing economy. Wall Street is doing well. People are spending money. This is why, I mean, it's one of the few countries growing. You have the US, you have the Middle East doing very well, you have India doing very well, you have Latin America, South America doing well. Europe is suffering, especially Germany and France. So the US, with the 300 million population, is a very important market.
And I have to ask, because we're talking the NFL, Travis Kelce just got engaged to Taylor Swift. Austin Butler is a part of your brand. I mean, I don't know. Could that be a potential partnership? And how do you look at celebrities and sort of how that leads into the brand momentum?
Of course, we work with celebrities. We have many friends and investors also within the scene. I was at the final last year where Trevor lost. I mean, the Eagles won.
Go Birds. I'm an Eagles fan.
It was, for me, my second game. It was an incredible experience. And it's very different from soccer. You know, in Europe, we're very much in soccer. It's much more friendly, more family. Kids can come. The party, and it was phenomenal. And I can't wait to see more games this year.
Okay, all right, so that's not a no. I'm going to be looking out for that potential Travis Kelce partnership. George, thank you so much. And of course, Praz, thanks for joining the conversation too. All your market action just straight ahead. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke Tamamo. We're live at the NASDAQ. Let's get a quick check of the latest market action. We're about 2 hours into today's trading session, and we've seen all three major indices reverse course to the upside here. The Dow leading the momentum, up nearly 0.3%. The NASDAQ up nearly 0.2% ahead of that key Nvidia earnings report after market close today. And the S&P 500 also reversing course here, up about 0.2%. But the Dow really leading the momentum here once again, up nearly 0.3%. And if we take a look at what exactly is leading that momentum here, if we go to equal weight, we have Salesforce leading some momentum, up about 1.5%. We also have IBM really continuing the gains that they saw earlier this week after they announced that they would be teaming up with AMD to build the future of computing. Certainly something to keep an eye on as well. That stock up about 1.1% in early innings here. But I also want to take a look at the NASDAQ because really all eyes among investors is on that key Nvidia earnings report out after the bell. Year to date, Nvidia has had quite the run, up more than 35% year to date. Many calling this a bellwether of the rally that we've seen this year, as AI and tech really have been the name of the game when it comes to the momentum that we've seen behind the rally among, the S&P 500, but also the NASDAQ. If you take a look over the past 3 months, we've seen this rally up about 12% from the NASDAQ, largely led by this AI and the Mag 7, and that momentum is expected to come down really to today and what we'll hear from Nvidia. And so all eyes will be on that. But once again, taking a step back, all three major indices in the green this morning. But keep it right here on Yahoo Finance. We'll be tracking all the latest market moves throughout today's trading session.
Now time for some of today's trending tickers. We're watching Smucker, Abercrombie, and American Eagle. First up, J.M. Smucker, the maker of peanut butter and jelly, reported that first quarter net sales were weighed down by decreased sales of coffee, dog snacks, sweet baked goods, and fruit spreads. But it did boost its outlook for the full year to a net sales gain of as much as 5%. That's up from as much as 4%. Still with us is our own Brooke DePalma. And Brooke, you've been following the coffee wars very closely here. Is this at all surprising to you?
Yeah, I mean, what exactly we're seeing here is J.M. Smucker come under pressure this morning, largely because post-COVID, we heard this large momentum about at-home coffee. Smucker's is still bullish that about 70% of U.S. consumers drink their coffee at home, despite this return to the office post-pandemic. But what really is concerning investors right now is the cost of coffee and what exactly this means for green coffee beans when it comes to not only tariffs, but other weather effects that we've seen on the price of coffee. And in the call this morning, they did say in their prepared remarks that the current outlook outlook for pricing in the coffee segment is going to be in the mid-20s. They said that they'll likely see an impact to volume in the low to mid-teens because of these price hikes that the company has had to take in both May and August. And now with these tariffs on major sourcing regions like Brazil, in addition to just weather concerns that are happening there as well, it's likely that they'll have to take further pricing, and we're definitely seeing investors not too pleased about that this morning.
Shares down about 5%. Next, Abercrombie, the company raising its full-year sales guidance after a strong quarter for its Hollister brand. Now, Brooke, I remember shopping at Abercrombie back in the day, shopping at Hollister. We're seeing a nice pop in the stock, up around 2%. However, year to date, we are still down more than 30%. So this is a company that is struggling to keep up.
Yeah, Hollister really winning over Gen Z with, get this, Allie, their Y2K collection. They said that they're seeing some momentum around the lace trim tank tops, the baby doll tops that are apparently back in vogue, and that's making some good bellwether into back to school season ahead of what they've seen so far in the third quarter. They were talking a bit about that. We've seen Hollister same-store sales growth up 19%, and as a Abercrombie & Fitch, that core brand that's really gained the attention of millennials, perhaps they're pulling back a bit there because that brand's segment actually saw same-store sales growth decline of about 11%. And what we're hearing more on the call is that, and what we're hearing from really sources on the street, is that Abercrombie & Fitch has been able to sort of withstand this pullback in consumer, this broader, choppy consumer environment. And hey, maybe that's really leaning into the Gen Z consumer. That's where Hollister is winning right now, really leaning into that nostalgia factor, and that's boding well. But of course, right now, the big concern as well is how exactly they're navigating tariffs, as well as so much uncertainty, especially moving into the holiday season. How will they handle promotions and inventory and all that, certainly as well. But we are seeing the stock roughly flat, up about 0.5% today's trading session.
You know you're getting old when Hollister is now considered nostalgic. But finally, another retailer on our eye, American Eagle. Following its controversial campaign with actress Sydney Sweeney, the company has now nabbed football player Travis Kelce as its newest face. And Brooke, the timing here cannot be better. Travis Kelce, Taylor Swift just got engaged. I mean, this feels like it would be huge for this stock and the company at large.
Yeah, Allie, I have to quote Taylor Swift here because everything that this man touches is happiness, fun, and magic. And we're seeing that similar reaction among investors this morning from Wall Street. The stock up about 5%. And there's this momentum behind, could this, not only the engagement, but also this marketing campaign. We've seen so many companies pull up their set to be announced marketing campaigns, trying to back off this engagement. So I wonder if this was the day that it was actually supposed to be announced, or if perhaps they pulled it forward. But it's important to note here that, analysts on the street, although it's exciting, no notes yet around this Travis Kelce partnership. Also, I do want to note here that BofA recently downgraded American Eagle. They cited that they, from an underperform to an underperform from a neutral, they cited that they see a longer path to more normalized earnings profile in this environment. We know that American Eagle is in the midst of a turnaround story here. We don't exactly know if that attention that they got around Sydney Sweeney will lead to long-term momentum. Of course, similar notion here with the partnership between Travis Kelce. We also know that American Eagle and their brand Aerie have really leaned into promotions. We also know that they're in a tough position to navigate tariffs. Right now, about 30%, or rather 20% down from 30% of their product is still sourced from China. And so there's still lots of unknowns when it comes to American Eagle, but certainly happiness, fun, and magic for the stock this morning after that partnership.
Yep, at least today. But to your point, Brooke, we're still seeing shares down about 20% since the start of the year. Thanks so much. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, Fed Chairman Jerome Powell's Jackson Hole comments opened the door to a September rate cut and gave further support to the market rally. But what risks should investors be keeping on their radar? Joining me now is Duncan Tons, HSBC strategist. So Duncan, you've called stagflation the biggest risk to U.S. markets, and that's when growth slows, unemployment rises, but inflation stays stubbornly high. Why do you see that risk building now, and what does that mean for everyday investors?
Yeah, look, I mean, what I would say around stagflation here is essentially the risks are more on the inflation side than the activity side, right? Stagflation isn't good for the Fed because it creates risks to both sides of the dual mandate and makes it hard for them to prioritize one over another. Where we're looking at stagflation, it's more on the idea of inflation looking like it's really gathered a little bit of momentum in that goods sector and also in the services area. Elsewhere, we take more of a dim view of stagflation being a driver on the activity side of things. And that's because a lot of the high frequency data is really pointing to the upside here. So essentially, what we're seeing at this point in time is less of a view of stagflation coming from the activity and more of a risk around the inflation side of things.
But markets are still pricing in that September rate cut. So what are the longer term ramifications if the Fed is cutting into a stagflationary environment?
Yeah, look, we would more take the view that the risks around the Fed are perhaps we're seeing too much more on the dovish side at this point in time. And that really reflects the view that if we are seeing a re-acceleration in some of this high frequency activity data, then that really creates the risk that perhaps the Fed is being a little bit too dovish going into this versus some of the near-term data momentum. So really the way we're looking at things is that perhaps some of those cuts that are in the price over the next year or so could be a little bit too aggressive. And that's if we start to see this idea that the US economy is doing better than expected.
So do you think markets are underpricing some of that risk right now? And where would that be most obvious? Is that in equities, which has obviously been rallying, or rates?
Yeah.
Because the bond market has been pretty chill, all things considered.
Look, this is more of a play for the rates and the FX space. Certainly with regard to risk assets, we think some of the key drivers are more around the earnings outlook at this point in time. So if we were to see some of those rate cuts come out of the price, that doesn't necessarily mean that risk assets need to suffer, because initially the impetus is coming through from that Goldilocks market reaction, right? The idea that higher rate expectations are reflective of more of a re-acceleration if that occurs in the activity data. So risk assets at this point in time, more driven by the earnings outlook. And there, of course, we've seen a stellar Q2 earnings season. And that's something that we could expect to continue later on this year as well.
Yeah, strongest earnings season since 2021, but your framework still flashes a mild sell signal. So how are you positioned right now, and what would turn that into a bigger red flag for you?
Yeah, so the sales signal you refer to there is around sentiment and some near-term sentiment signals, looking like perhaps the market is a little bit too excessively exuberant, but that doesn't suggest that we need to see equities pull back in the immediate near term. What we actually need to see is a fundamental trigger to see an equity pullback and see a more of a risk-off move. And that's not something that we're looking for right now, be that through the macro data or be that through the kind of bottom-up analysis with the earnings season. Really going forward, I think the idea around further AI adoption and AI adoption being able to mitigate some of the tariff headwinds is something that we should be focusing on for the earnings seasons ahead.
Now, given AI adoption, we have seen mega cap big tech lead a lot of the market gains throughout this bull market. However, there has been that rotation story underneath the surface. So do you think that we can still see this rally in stocks if maybe big tech isn't performing at the levels that they have been?
Yeah, absolutely. I mean, when we look at broader earnings expectations, we've got to remember that if we go back 2 months ago, earnings expectations for this Q2 earnings season were 6% lower than the actual outturn. And all the while that we've seen these positive beats and company management be fairly positive in terms of their guidance, we've really seen Q3 earnings barely budge in terms of those expectations. So going forward, if we don't see expectations move much for Q3 and we continue to see broader AI adoption with more companies across the sectors suggesting that they're going to adopt AI over the coming 6 months, then that really should be something that could broaden out the equity market rally in the months to come.
Duncan, appreciate those insights. Thanks so much.
Thank you.
All your market action is straight ahead. Stay tuned. You're watching Market Catalysts.
The street has been getting pretty bullish on Nvidia recently, right in time for Q2 earnings on Wednesday. Analysts have raised their price targets on the chipmaker by over 7% in the last month, as Luke Kawa notes on X. But critically, does Wall Street actually get Nvidia right? And that's our basic question to answer on today's Stocks in Translation. Now, first, a quick definition. A price target is an analyst's estimate of where a stock should trade over the next 12 months based on their models and assumptions. And as we noted, those targets have been rising for Nvidia recently. But first, we wanted to compare the increase over the last month to all of Nvidia's earnings releases over the last decade. Does it stand out? Well, this is what it looks like over the last 5 years. And notice the spike when the hype builds and the dips when analysts get cautious. As you can see, the recent revision higher shown in the last bar on the right here, pretty strong historically, especially for Q2 earnings released in August, which are the bars in white. Now next, we wanted to see how the stock price actually performs when Wall Street raises or lowers their price target in the month leading up to each earnings report. We find that you can group those analyst price targets into 3 buckets, which have very different outcomes for how Nvidia stock moves after the reporting. Now, in the first bucket, we put all the times that the street lowered their price targets, which happened 10 times over the last decade. In the second, we put all the times that analysts raised their price targets by up to 5%. And finally, we have all the times the street raised over 5%. This strongly bullish group was the most common outcome and happened 16 times. So that explains the 3 groups or clusters of bars that you're seeing. Now, within each of these 3 groups, we can see the median returns for various time frames following the earnings announcement, assuming that you bought right before the report each time. So the periods that we're showing here are 1 day later, 1 week, 1 month, and 1 quarter later. What you tend to see is that Wall Street gets it right over these time frames. To the left, when they're lowering their targets and a bit bearish, we often see weak or even negative returns until you get up to about the 1 quarter holding period, which is only about 7%. All the way to the right, that group, you can see some of the best returns for that very bullish group. Over 1 day, 1 week, and 1 month, you got about 5%. And then for 1 quarter, you got 23% historically. And right in the middle there, that slightly bullish bucket, that's where you mostly see returns in between the bearish and the very bullish groups, as you might expect. Next, we're showing just a 1-year holding time, and that's because the returns are so much higher, from 75% to 120%, that we just couldn't include them in the last chart. It just makes all the other period returns look tiny. And now we have a twist, because as you can see at the left, when price targets were cut going into earnings, that's that left bar, the long run results were the best. So bearish analyst moves led to the highest 1-year returns of all 3 groups. In other words, short-term pain led to long-term gain. And finally, in addition to looking at post-earnings stock returns, we can also look at the win rate. Here we're showing the percentage of time that the returns were positive, keeping with the same buckets and time frames, from 1 day to 1 year. The odds of winning largely match the results that we saw in the previous charts, which were showing returns. The big price target hikes generally came with the highest win rates. But once again, we get a surprise. If you only look at the long run, 1 year out, the best odds came when Wall Street was a little bit bearish, lowering their targets. So here's a summary of all our main findings. When the street is strongly raising Nvidia price targets in the month ahead of earnings, that's when you get the best stock returns after the release, if you're holding for 1 day, 1 week, 1 month, or 1 quarter. And if analysts cut their targets, so that's when you see weaker near-term performance on those same time frames. And here's the twist again, but you actually get the best 1-year returns when the street has been a little bit bearish, lowering those targets. So bottom line, when you take a look at that 7% price target raise that we've seen over the last month, the hype train is clearly boarding. And history doesn't have to repeat, but the odds favor bullish price action in the stock over the short and long terms. And tune into Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on